Master your emotions, master your risk smart.
What's up, everybody? Welcome back to RoyalBluFX. In today's video, we're going to talk about the most simplest, stupidest ways to find the flip zones as an entry criteria. So stay in this video, watch it all the way through. You guys are going to enjoy this video. And if you haven't already, go ahead and subscribe to this channel because we always give out free content, guys. We're doing all this for the love for you guys. And in return, that makes me happy because you guys are watching our content and are supporting our channel. I really encourage everyone to stay and watch this video from beginning till end because you don't want to miss out great information that we're going to be talking about. You guys are going to love it. Also, for those that are wondering about our online course, we're still building this right now. We're still building our website and the course simultaneously. Amazing things are happening. We're trying to ramp up this course as fast as we can so we can get it out there for you guys. Also, we opened up some slots on doing one-on-one sessions right now. So if you guys want to go ahead and click the link below to contact me directly on Instagram because our website isn't up yet and see how you can enroll on one of our one-on-one sessions. So let's begin with this video. All right, first things first, what is a flip? For those that don't know what a flip is, I'm going to draw a quick diagram here to identify what a flip is, okay? And then I'm going to show you more diagrams and how to find the flip a lot more better in terms of an advanced format, okay? Because a flip can be a little controversial depending on how you see the market structure and market structure behavior. So I'm going to show you right now quickly right here what the flip looks like. A flip essentially is a last sell to buy or a last buy to sell move when a chalk is presented, okay? That means at a supply or demand zone. So essentially, just kind of quickly, right, in the most simplest format, let's pretend this is the high, this is the high right here, right? This is the low, right? Price comes into a high, and we're going to be going on a bullish perspective here. When price does this, runs the high, right? And this is the last sell to buy that broke that main high, right? And this is where the buy comes into play, just like that, okay? Vice versa, when we have a sell coming into play, so we have it something like this. Let's go like that, like this, all right, like that, boom, boom, just like this. This is considered to be the flip, okay? So we had a chalk here, and the last buy to sell is right here. So we put that a supply zone over there, and we put a demand zone right here, just like this. All right, so again, just to iterate, we have a low here, right? Price breaks the high. Here's your sell to buy. That is your flip. Right here we had a break. This is your weak demand, strong supply. This is your flip. Now, these are flips because the market decided to, well, at first the market was bearish, right? So this is what's happening. The market was bearish at some point in time, right? And then decided to run the highs all of a sudden, right? Without, any expectations, without anybody, knowing what the market will do, price just reverses the other way around so fast. And then we wait for prices to come in here to continue our supply and demand structure, right? Same thing here, right? When everything was bullish at one point in time, excuse me, let me just do this better. Nope. Right here, when price was bullish, it was at one point in time, just like this, right? Price all of a sudden decides to take out the current low or the old low, right? And then it does this weak demand, strong supply. So then this demand try to go up to the high to break the next high, right? Because a lot of people anticipate to continue price bullish, but then price decides to reverse the other way around to then hit our flip zone, okay? This is the flip, right? So, all right, guys, so I hope you guys kind of have a basic understanding of what the flip is. I'm going to quickly go into now the more sort of advanced diagrams so you can see what I'm talking about. So we use the flip mainly just for entry criteria purposes. So bear here with me, and I'm going to break it down here, okay? So as you can see here, when price was bullish, right, it ran bearish here. This is the retracement. Then you get the impulse, right? The impulse is where price swept the last low right there. Let me just make that a little more clear right here. Just swept this low. Okay, so this is our swing low right here. Price comes back to the demand zone, just like so. And then we have the internal structure. So obviously we need confirmation with the internal structure. So what do we see here? We see that internally, we can see this high running this low, right? It respected the demand zone. So that means when price runs the high, here's the chalk again, right? Here's where it is. It runs the high. Between this high and this low, we have what's called a sell to buy, the last flip right here. And this is where the entry would be made. Now, there's different variations of this, so I want you guys to watch very carefully, okay? Because in the next diagram is going to be a little more different. You're going to see why, okay? Right here. Now, why would we enter here? It's not just because this candle, this move down here is the last sell to buy. It really isn't the last, I mean, it is the last sell to buy. However, what's more important to understand here is that price swept internal liquidity, right over here, as you can see. That is an internal old low right here, an internal old low, which means in order for the market to move, we need some liquidity to move price bullish, right? So in this case, you can see that this is a last sell for the break, happened right here, right? When it happened, we can then say to ourselves, okay, when we're ready to enter at this flip, where was price? Where did price sweep last, right? Where did price sweep liquidity last, right? It was right here. You can see it. You can see this low came and interrupted the order flow of price, right? And then ran, right? So it tricked everybody into thinking, it trapped a lot of traders here where everyone thinks, you know, there's breakout traders, break and retest traders right here. You know, the supply and demand traders probably all the way down here who are trading, you know, lower time frames, right? Who are waiting for price to continue the market structure bearish just like this, right? But then what price decides is to run bullish, right? And so what we're looking in this, from this height of the slow, we're looking and we're measuring price and saying to ourselves, okay, if this is the low, okay, this is the origin of the low, okay, this is the origin of the low right here, right? This is the origin of the low that broke this high, right? But then we have internal low right here that also caused the break of this high. So in theory and in factuality too, what we're analyzing here, what we're analyzing right over here is which structure, right, which low broke the high, but which low caused the sweep, okay? So in this area right in here is where a lot of traders are trapped. So what happened is price decided to move impulsively bullish to then come back to a demand zone, and this is our area, our key entry here for us to enter to run price bullish. This happens a lot of times, okay, and very frequently in fact. So I'm going to show you guys in the live chart in a few minutes after this. So let's go to this second diagram right here, okay? This is a little different. It's almost the same as this first one. So I'll refer back to this one when I get back to when I show you guys this one here. So right here, okay, the same scenario, right? We have the sweep, price runs, price comes back, price sweeps the internal low here, right? Then takes out the high. Now there's two different, it's a little different here, but I'm going to show you guys here. Okay, so you can see that there's a high, but this high is sticking above this chalk. So this is another type of flip. Essentially, what's happening here again is there's a low, internal low that's being swept, respecting the main low right here, right? And then price runs the high. What does it do? It breaks a new high now, right? So it broke this old high, then this is the next old high right here, right? Just like that. And we're essentially following order flow, right? So what you're seeing here is this is a flip that broke out of this internal high, okay? I want to reiterate this again. This is the high, a new high that was not inside of this chalk, okay, of this swing, of this high in here. It actually broke out of the high, okay? But more importantly, what it did is when price reversed and when it retraced, it also swept some liquidity, mitigated, ran again. So what do you see happening here? We have traders again trapped in here. And what does price need to do? Come back to mitigate this demand zone, which is the demand that swept liquidity, okay? This is the pullback, the full extreme pullback right over here, right? So this is where we would be interested in looking to buy to go long. Now, if I show you this diagram compared to the other one, notice how, again, this diagram broke out the high. This is the high that broke this chalk, right? Look at that. This high broke that chalk, right? But look in here. This high here, right, respected this high here, right? So it didn't break above. So there's two ways to see this, okay? This is very powerful. Now, you need to obviously be able to spot the sweeps of the lows or the highs in this matter too if we're going bearish. I'm always drawing bullish diagrams because they're just much more easier, and anytime I'm trading the US 100, I'm always most of the time I love buying rather than selling. It's just how I feel when I trade. Okay, so let's continue here. So again, right, didn't break this high, right? ran the high, respected, but it did the same thing down here where it swept the low, price came back to demand and ran up. This one did quite the opposite. It broke the high, but yet it did sweep the low. Notice we didn't run here to this low to start entering, right? We want to be second in, not first in. That's key, because a lot of people are trying to always be, impulsive and buy quickly, or be first in rather than second in. Second in is also great. Sometimes it's a third in, right? So this is a great little example here. Okay, so let's look at the third one. Okay, here's what's happening in the third. Now here's how you don't enter on these flips. There can also be misguided diagrams that the market obviously presents, right? Because not everything is 100% in the markets, but we need to be able to read this, right, and follow our rules based off what we see. So in this case, it's the same diagram again. We have a chalk, right? Price took out the low here. It also took out the high. However, you can see price coming in here, right, stopping midway or whatever, about 50% of the EQ, right? It doesn't mitigate a demand zone. Now, a lot of people start assuming that this is a demand zone right here, and what they start doing is price comes in here, right, and they think they should buy here, right here, because this is a sell to buy. However, we need to ask ourselves, what is happening before the break of structure, or even when the break of structure has happened? Okay, what has happened? What has happened between this high and this low? Where's the liquidity, right? The liquidity is actually way below this low right here. So that is a low, right? That could be inducement in the market, right? It could also be a double bottom. It can be anything, just as long as we know that before the flip happens, there has to be liquidity swept somewhere or another, right? Whether that's inducement, whether that's double bottoms or triple tops, triple bottoms, right? Or it could be a whole bunch of sideways, range, right? Something like that, right? So it's important to identify the flip correctly, because you can be misguided sometimes, where when price runs like this, a lot of people start doing this. Price doesn't come and mitigate, right? So a lot of people see this low and they say, oh, price broke another high, so I must be buying here, right? And before you know it, the market's already gathered enough liquidity to the point where it just does this, right? Comes in like this, right? So price can either do this, because it created enough liquidity, right? That would be your liquidity pool right here, your relative lows, right? Because it does this, it could use this as a potential flip. It can actually. So there's different variations, right? But what we don't do here is we still don't enter on this flip. Even when price presents liquidity, we still don't enter on this flip. Why? Because liquidity, everything can be seen a lot different depending, it can be seen the same or different depending on how we see and how much confirmation we give price, right? So because there's liquidity, a lot of people start to unload on their positions here and start buying here, right? But again, we can't confirm this is a swing. It's not a swing low, right? It's not a swing low, and it didn't take out liquidity. So we need to be very careful here, because the way I see this is we would need to wait for price to reconfirm here again, right? So we need to do this again, create a new swing low. Once it does this, then we're welcoming another entry right here. You can see this low was taken, this high was swept. There is no flip in here, and that's okay, because flips are not the only ways to enter. We also enter in this way as well. Just a plain old chalk. Change of character, sweeps out the low, chalks right, and you go for the entry like this, right? So you can see that there's just a few variations, but just in case you want to be able to see price correctly in terms of flips, they're the most powerful, if not the most powerful ways to enter. Okay, so I hope you guys understand this variation here, because it is a little different, right? Another thing I kind of also want to mention here before we go into a live chart example is that when price does move like this, it can move. It never has to come back down to the origin, right? The origin of the move, the origin of the move that created this low that chalked here, right? It never has to come, because a lot of times price just starts to run, creating internal small liquidity just like this, or structure just like this, right? And it does so just to let other traders go in on this move, right? Just to manipulate other traders to go in long, right? So when price broke the high there, let me move myself over here quickly, right there, right? Let's just say price went long like this, right? It's gonna get other traders to come in here like this, to buy right here, to try and continue long. Although we know that a lot of internal liquidity has created right here, right? Which means price could all sweep this, right? And then we wait for more confirmation just to continue price bullish like so, right? So anyway, these are just a couple of ways to find out how to identify the flips and how to enter off of them. All right, make sure you identify the flips correct, okay, because that is the very best way to do them. Okay, so onto the live chart right now. I'm going to show you guys how to identify them and how to see them better, okay? All right, guys, so here we are on a live chart example. I just want to show you quickly, guys, that we're here on the 4-hour right now. 4-hour just swept liquidity right over here, right? These are your relative lows right here. Swept the lows, swept the liquidity, and now we're working our way bullish up here, right? So if I just draw your attention over here, you'll see what happened. So right over here, I did the liberty already to draw out the stuff. Yes, I'm cherry picking just to show you guys how simple, stupid this is really. You'll see here on the 30-minute we have a chalk, right? So right over there we have a swing high to a swing low, right? And you can see that this high was broken. Now we ask ourselves, who broke this high, right? You draw your attention all the way down and you see that this is the low right here. In fact, let me just do this here. This is the low right there that caused the break of this, not because of this break of high, but caused this break of the high right over here, right? So that was it, right? This low caused the break of that high, right? But more importantly, it is a flip, right? Now a flip, again, is the last sell to buy, right? If we're going bullish, it's the last sell to buy. So again, who broke this high? It was this last sell to buy. You can see that this flip, we want the flip to sweep liquidity before it breaks the high, right? So right over here, you can see that the low was swept, right? You can see there that liquidity swept. I can even just go in a little further in so you guys can see it a little bit better, more detail, okay? You can see that that low right there swept liquidity and it ran the high. So that means that our point of interest is this demand right here, right? You can see when price ran, does this need to be swept? Because all this is manipulation, right? When price swept liquidity, this low here, it ran, price came back,